Hello and welcome. My name is Becky Leese. I am the staff liaison between the Council of State Governments Midwestern Office and the MLC Agriculture and Rural Affairs Committee. Joining us and moderating today's webinar are three of our committee chairs, Senator Rob Kupek from Minnesota, Senator Paul Thomas from North Dakota, and Senator Teresa Ibach from Nebraska. Together with the chairs of this committee, I'm pleased to provide you with this webinar focused on the ag economy and specifically on the challenges and opportunities for agricultural businesses. As a reminder, this webinar is being recorded and the slides and recording will be available later on our website. This webinar is set up as a meeting to enable attendees to participate in a discussion following the presentation, so please make sure your cameras and microphones are properly adjusted. Senator Thomas, I'll turn things over to you.
Thank you, Becky, and good morning, everyone, and thanks for joining us. Today's session marks the beginning of a new biennium with new and familiar colleagues making up this committee of legislators focused on ag issues impacting each of our states. As lawmakers, we need to stay abreast of economic issues. While information is plentiful, it isn't always cohesive. Having an expert help us digest new and changing information is essential as we consider and craft new policies. Over the next hour, you will get a chance to hear from Dr. Chad Hart, a professor of economics at Iowa State University and a renowned expert on ag economics. Following his presentation, we will also have a couple of ag business leaders and trade association representatives that are willing to share their perspectives. For those agribusiness leaders, please indicate that you'd like to share your perspectives and we'll take those before taking additional questions. I will now turn things over to my fellow co-chair, Nebraska Senator Teresa Ibach.
Thank you very much, Senator Thomas. I appreciate it. And this is my first event as co-chair of the Ag and Rural Affairs Committee. And I'm pleased to be here. Looking forward to meeting many of you up in Saskatoon in about a month. With us today, we have Dr. Chad Hart. He's a professor of economics at Iowa State University, and I don't hold that against him because I have several Iowa State friends, including the late Bill Northey, that are alums of Iowa State, and I admire all of them. And we also partner with Iowa State on our Vet College 2+2 program. So we have a lot in common with Iowa State, and I have a great admiration for Dr. Hart as well. His field of interests include the interactions between the ag commitments within the World Trade Organization, or the WTO, and the ag policies and programs of the WTO members. Also, he has interests in crop insurance, international trade, biofuels policy, federal ag policy, and of course, crop marketing, which we had a short discussion earlier on the marketing of different crops. Chad was born and raised in Southwest Missouri, also a neighbor to Nebraska, where his parents raised a few cattle and they operated a small meat locker, which, coming from rural Nebraska, I appreciate very much. He received his bachelor in economics with minors in mathematics, history, and astronomy from Southwest Missouri State, and a PhD in economics and statistics from Iowa State University. While serving in multiple roles with Center for Agriculture and Rural Development, Dr. Hart was also the U.S. Policy and Insurance Analyst with the Food and Ag Policy Research Institute. So very impressive resume, Dr. Hart, and we're so glad that you could join us today. And we really, truly look forward to your comments and some of your insights in agriculture across not only the Midwest, but the nation. So I will turn it over to you now.
All right. Thank you, Senator Ibach. And it's my pleasure to be with everybody today. And so let's see here. I'm going to share my screen if I can. So let's see if that works. Whoops. Gives me the wrong view. Bear with me. I'm going to try that again. Let's try that one. That looks a little better on my end. So what you should be seeing is a full screen. This is the ag and the agribusiness economy. And to give you a little more background on myself, my main appointment here at Iowa State is dealing with crop markets, mainly on corn and soybean side. But given my background, as the senator mentioned, grew up in a meat locker, know something about the livestock industry, have worked here within the state for about the past 35 years. on anything related to agriculture that carries a dollar sign with it. And I hope that you'll share in either in the chat or in the Q&A later on questions that you might have as we're going forward with this presentation. But to begin with, I wanted to sort of lay out what is happening with in the ag economy right now. And this is some national data here from the U.S. looking at net farm income in the blue line there, and then the government support and the payments that have been made when we're looking at the red line there. And when we think back over the past few years here, we've had the COVID crisis, starting back in 2020, and you can see that farm incomes actually held up fairly well despite that challenge. And in fact, we saw net farm incomes rising in 2021 and 2022. In fact, here in the U.S., we set a record as far as national net farm income during that year. But since 2022, what we have seen is a fairly significant drop off in farm income. At the same time, we have seen farm cost rise very quickly over the past 5 years, and that has put a pinch on the farm economy, especially within the past 2 years for farmers. Now, as you look at the end of this chart, you'll notice there is a spike back up, but that is mainly coming from federal government support here within the U.S., helping provide, if you will, some support to the industry at a time that it continues to struggle with lower prices, especially in this case on the crop side, along with still those higher costs as we move forward. In fact, one of the challenges I would say agriculture is still facing right now is, let's call it, the longer term effects of the inflation that happened over the past couple of years, that those higher prices are now baked into a lot of the input costs our farms and agribusinesses are seeing, and they're still wrestling with how to control those costs while at the same time trying to figure out how do they boost revenues after a lull in those over the past couple of years. Now, that change, like I say, is fairly precipitous as we're looking here. This is looking at the change in farm income, but now the red line is showing you the change in expenses as well. And so, especially throughout 2023 and going into 2024, that's when we saw truly the farm economy downshift significantly. That has now had a ripple effect across the broader agricultural economy, as especially in 2024, we began to see agricultural businesses start to pull back on investment, start to lay off workers in some certain key industries, and we're still feeling the effects of those pullbacks here in 2025. The other sort of thing going on in the back of this, though, is that as we're looking at the farms themselves, the farmers are still adjusting to this shift in lower income as far as not only their expenses in running the farm, but their expenses in how they supported their families as well. And because of this downshift in income, we have not only seen a pullback in farmer spending for their farm businesses, but we've also seen a pullback as they're looking at their personal expenses as well. That has created, again, another ripple effect impacting our rural communities over the past year or two. So these challenges are not necessarily new when we're looking at agriculture. What is new this year is this challenge as far as policy uncertainty, especially when it comes to trade. When looking at agriculture across North America, what we have developed is a great economic engine within agriculture, but it is built to fill, if you will, the global environment. That North American agriculture, we produce more than we typically can use here within North America, and we depend upon being able to sell out to various parts in the rest of the world to help generate this income. Now, with the policy uncertainty around trade, especially, that has diminished that outlook, at least here in the short run, as farms and agribusinesses learn to work within this new policy environment that we are facing. And one of the things that farmers are doing right now in order to manage this is they have picked back up the leverage that they need to run their farms. This is a graphic looking at overall farm debt again here within the US over the past 20 some years. And you can see that for the most part, what we tend to see is, rising debt levels across the farm sector. At the same time, too, I'll remind us that what this also means is we see rising values within farm assets as well. In fact, when we look at the debt to asset ratio of the farmers across North America, what we find is it's still in a very good spot. We've been able to actually pay down some of that debt over the past few years. As you look at the dip there around 2021 and 2022, as what farmers did with some of that surge in income that they saw coming after COVID is that they reinvested it back in their farm businesses, lowered their debt structures where they could, but also had been very aggressive in buying new ag machinery and finding the supplies that they needed to expand production. Now we're still doing that as we look here in 2024 and 2025, but we're having to do more of that through leverage, through debt, than utilizing the additional income that had been coming in earlier in the decade. As far as some of the recent movements we have seen within the ag economy, and this is strictly looking at prices here, what we sort of seen is a mixed bag. So how how weak is the ag economy right now? It truly depends upon the focus that your region has within agriculture. In this case, it's a mess of lines in there, but it's basically covering some of the major crops and livestock industries here in North America. And the general trend is this, is that when we look at the livestock sector, for example, what we're experiencing right now are very strong prices, in fact, record prices for our cattle industry. But at the same time, too, we're facing a record cost for that industry as well. And so higher prices do not necessarily lead to higher profitability. In fact, we're looking at a break-even scenario across most of the livestock sector. Dairy is sort of caught in between here in that the dairy industry hasn't seen the rise in prices like we've seen on the other sectors within livestock, yet they're continuing to see those higher costs. And that has put a pinch on the dairy industry as we're looking there. And then as we look down towards the bottom end of the graph, that's where we're finding a lot of our crops. And as we're looking at why crop prices have moved down, the big challenge from the, if you will, the farm side is that we are seeing incredible productivity across North America. In fact, as I look at U.S. Department of Agriculture estimates, as we look here in 2025, we are looking at the possibility of the largest corn crop we've ever had. We're looking at a soybean crop that would fall within our top 5 historically. We're seeing incredible production, and that production has weighed down on prices. And when we do see a low price, high yield environment, those actually tend to be lower income years for the agricultural sector than if I were to turn that situation around and we were looking at higher prices but lower yields. So in a certain sense, a little weather volatility does tend to help farmers more when it comes to the pocketbook. And because of that, since farmers are seeing lower incomes, we're seeing lower investment by those farmers coursing that money through agribusinesses right now. And that's why we have seen some dramatic shifts when we're looking at the agribusiness industry over the last 18 months. Now, in terms of that cost structure I've mentioned, the idea is over the past 5 years here within the state of Iowa, and I'm going to use Iowa as sort of an example for the rest of the North America here, we have seen that overall increase in cost to produce agricultural products. In the case of Iowa corn, nearly 33% higher over that 5-year period. And as you can see in the case of these costs, they have not moved down nearly as quickly as prices have over the past couple of years. That we continue to see strong costs to be able to either purchase or rent that land for agricultural production. We have seen labor cost rising, and especially in the case of not only have we seen the cost for labor rise, but the challenge of finding adequate skilled labor, especially in our rural communities, whether working on the farm or within the agribusinesses supporting that farm. That has added to the cost. You combine that with, we've seen fairly strong prices for energy and especially fertilizers over the past couple of years, adding to that cost as well. And then finally, when you look down at the bottom there, the machinery cost is the one that where we've seen the largest increase over the past 5 years. As farmers have looked to update equipment, that has led to a challenge into just how much money they have available in order to keep to the latest and greatest equipment as we look out there. Now, in terms of an overall summary, one of the things I like to point to is when you're looking at the ag economy, one of the big things I know I watch is how farmers are interacting with their lenders. Because when we typically see a downturn in the agricultural cycle, that's when we'll start to see that stress popping up within this lending industry. And that's exactly what has been building up, especially here within the past year, year and a half. As you look at this data, this is from the Federal Reserve of Chicago that does a very specific survey asking agricultural banks what they're seeing in terms of loan demand, fund availability, loan repayment rates, but also looking at what's the average interest rate being charged for farms, not only on real estate loans, but even more importantly, on those operating notes that farmers tend to use from year to year. And what we have seen is in 2024, a dramatic shift up in loan demand, a shift down in fund availability, a shift down in loan repayment rates, and definitely we have seen those higher interest rates appearing over the past couple of years here as countries fought off the inflation bug by raising interest rates to slow the economies down to hopefully tamp those inflation rates back down. But even with inflation rates being more under control today, we still see some fairly high interest rates for the agricultural industry right now. And that is creating an additional cost as farms and agribusinesses look to see how can we cover those additional interest charges we're facing now that we really haven't had, or if we haven't had to this, if you will, to this size over the past several years, given the low interest rate environment we had for most of the 2010s. Now, when looking at the broader agricultural economy, I'm going to use Iowa again as a microcosm. In this case, this is the Iowa economy based on some BEA data from 2024. I believe there may be one more quarterly update they've done since I pulled this data. But I like to bring this out because it shows, if you will, how volatile the agricultural economy can be within a state or province. This is broken down by sector. And for those of you with eagle eyes, you'll see that agriculture appears in the upper left-hand corner. Direct production agriculture in the state of Iowa only represents in 2024 roughly 3% of what we were seeing in terms of the GDP development for the state. Now, if I were to take you back to 2023, agriculture would have been more like 8%. So we've seen a dramatic shift down in the value agriculture is creating, and a lot of that is due to the drop in prices we've seen on the crop side, along with the limited profitability we're seeing in the livestock sector due to the higher costs. Given that downward shift, we are seeing impacts across the rest of the Iowa economy. In fact, as we look, like I say, quarter to quarter, in this case, we have seen, like I say, a fairly sizable drop in the agricultural values here in the state of Iowa. If you're in a more livestock-oriented state or province, you're likely seeing less of a drop in your agricultural values, but you're still experiencing a drop there. Also, if you have states that are more energy dependent, you're probably seeing less of an impact there as well, as energy prices have held on better than what we've seen on the crop side. But throughout the Midwest, we have definitely seen this challenge of the ag economy has been in a decline mode for the past couple of years, where other sectors of the general economy have not at this period of time. So there has been this disconnect between the agricultural economy and the general economy. That said, though, the farm economy does feed through to the rest of the general economy. For example, when I'm looking at the farm machinery, that step down in agricultural value means less income for farmers to spend for farm machinery. And we have definitely seen the impact of that as we've seen companies like John Deere and AGCO have layoffs, rearrange production facilities, and look to reshore some of their production as they've gone through the past year, year and a half in dealing with the slowdown in sales because of the drop in the ag economy. We have seen an impact on the insurance side. One of the biggest industries here in Iowa is the crop insurance industry, and we have definitely seen changes within that industry. It's tightened up as far as its regulations, but probably one of the bigger shifts that our agribusinesses are seeing right now is more limited choices when it comes to especially property and casualty insurance across the industry here. One of the um, I guess bigger trends, I'll say, as we look at agriculture over the past 5 years here across the North American Midwest is that we have seen more impactful storms. In fact, we were just discussing that before the webcast started here, that we've seen more storms creating larger financial impacts to agriculture come through over the past decade than we sort of used to see in the past. And in fact, a lot of those impacts are showing up not directly on the farm itself, but to those farm businesses that we're seeing more damage to our cooperative systems, our grain handling systems. And therefore, it's our property and casualty lines that have been hit. And because of that, we've seen more losses in the property and casualty insurance industry, and in fact, a pullback of some insurers from some Midwestern states, which is causing higher costs for insurance in those states. We're also seeing when we're looking at, again, impacts from the downturn in the ag economy, that impacting not only private industry, but the public sector as well. In fact, one of the bigger departments here within the state of Iowa is the Department of Agriculture. And with the downturn in the ag economy, that has meant that we've tended to rely more on sort of the support structures being provided by not only the federal government, but state governments as well. I know here in the state of Iowa, for example, one of the big things that was in debate as our legislative session happened earlier this year was looking at funding for what is known as our Grain Indemnity Fund. This fund basically provides, if you will, bankruptcy protection within our grain handling industry within the state. And we were looking at one, we have seen more claims on that fund over the past couple of years, along with that fund being locked at a fairly low funding level over the past couple of decades, that was combining to create some policy concerns as the state looked forward, which they had to adjust over this past session. And then, first and foremost, I would say on farmers' minds has been the impact we're seeing on the value of their agricultural land. When we think about the ag economy, the large asset that sort of drives the entire business is the value of our agricultural lands. That value tends to be the collateral by which we're able to, gather that debt, to use that leverage to push the business forward. And at least thus far, what we've seen is that even though the ag economy has pulled back some, we have not necessarily seen that chain all the way through to create lower values on that most critical asset. And that's what's helping support the industry at a time where, again, the short term finances coming to the market are challenging. Now, as I mentioned, I tend to look at this from the farmer side, but as we shift to look towards agribusinesses, the like I say, the challenges have been here since early 2024. This is just a gathering of some of the headlines that I've been able to snatch over the past year and a half that's looking at the changes we're seeing within our agricultural businesses. Whether it's large companies or small companies, we have definitely seen a pullback in employment. This mentions layoffs at many companies across our agribusiness sector here. And this really started in 2024 before a lot of the policy uncertainty really hit here. It shows that it was that farm income drop that led to a lot of these changes within agribusiness as we're looking forward here. And like I say, it's not just a big versus small industry issue here. This is hitting across the board. In fact, my favorite one to pick on here is that one in the lower left-hand corner about an indoor farming company. The challenges are hitting whether we're talking row crop, whether we're cropping livestock and meats, the idea of specialty crop. We are seeing that same pressure building on agribusinesses across the board. And again, you combine this idea that we're reducing the number of workers we've got within each company, along with these companies trying to position themselves to, if you will, reemerge and regrow when the ag economy turns around. Because we know that the agricultural economy, it goes through cycles. And about, every 7 to 10 years, we see a downturn in the economy, which lasts for a few years, and then we pop back up again. So these agribusinesses are looking, yes, we have to shrink now in order to fit the limited sales that we have at the current moment, but they're also looking to how do we reposition ourselves for growth when we see that turnaround that we know will come within the agricultural economy. And some of that is being driven by a combination of looking at not only are we having to lay workers off right now, but we also know that the labor market is tighter than it has been in some time, that we know the skill set of the available labor market is not necessarily matching what some of these ag companies are looking for. And therefore, we are seeing higher wage rates and labor rates being needed to attract that critical labor. And within some of these industries, we have also been reliant upon pulling in workers from the rest of the globe to help support those industries, especially as we think about some of our more specialty crop production or meat processing. That's where we've tended to use more immigrant labor to bolster up the supply of labor we could get from the domestic supply in order to maintain and run those businesses. Now, getting into this year, tariff uncertainty has also stalled business decisions. In fact, I was on a panel last week with representative from Kinsey Manufacturing, but we were also talking actually at a distillery here within the state of Iowa, and the owner of the distillery mentioned that even though we're looking at an Iowa distillery, you're thinking, okay, Iowa, yeah, we produce some whiskeys, the idea is corn makes alcohol. But the idea is he was talking about how his business decisions have stalled out as he was looking at in 2023 and 2024 investing in globalization patterns, trying to get into the European market, looking to enter in some of the Southeast Asian markets, and that sort of investment is now on pause, waiting to see what trade policies will be in the long run before making such decisions as they look out there. And that is like I say, a major challenge that not only that one small distillery was looking at, but that was echoed in the remarks from the representative from the Kinsey group, that the idea that they were seeing the same thing, that they had stalled some of their recent investments, waiting for clarity so that they knew, if you will, how the trade policy would impact their economic decisions moving forward before deciding how exactly to invest in those new opportunities. Do we invest more domestically? Do we look more globally? Those questions depend upon having more certainty as we look within trade policy. Now, how have agribusinesses responded to the downturn? And in this case, I'll specifically point to the tariffs as well as creating some of that uncertainty. And I want to point out in this case, this comes from an article written by a Canadian law firm that is looking at how do they help their agribusiness clients as they look forward in responding to these changes in trade policy. Of course, one of the big ones I think that's happening across North America is that if you're involved in agriculture, we're definitely watching to see how federal and state and presidential governments respond to these changes, and do they offer up potential support programs. I believe in both the US and in Canada, we have seen at least our federal governments respond with some idea of either some sort of support program or a remission program to help our agribusinesses deal with the potential higher cost coming from this trade uncertainty. We're also seeing a lot of businesses basically review their entire supply chain management process and look at what are the possibilities for adjusting that, given we may see more limited trade across the globe. In fact, that's one of the things that the representative from Kinsey last week specifically pointed out, is that they were doing a systematic review on all of their raw materials, looking to see, if you will, how much could be domestically supported, what are the potential variations in cost because of that, and how they could re-examine how they process and create their agricultural machinery in such a way to lower the cost and lower the uncertainty of, if you will, future trade policy uncertainty. And so looking to diversify their suppliers, but diversify in a way that focuses those suppliers where they are more domestically oriented, if you will. Another big one that I've heard a lot of is basically the idea of looking at reshoring certain key facets of agricultural businesses, looking at promoting domestic agricultural trade and collaboration. So they've seen, if you will, the idea of utilizing things such as Made in the USA or Made in Canada marketing to help promote more domestic usage of their product. Therefore, they would be less dependent upon trade as they're looking forward within their business. They're also looking to see, again, can they move certain key component manufacturing where it is closer or where it is less affected by trade policy. In fact, when talking with companies like Kinsey or Deere over the years, they have made those moves over the past 30 years as well. One of the key features, I think, for many of our larger agricultural businesses has been they've been reshoring, if you will, within North America, utilizing the, if you will, what the USMCA or the NAFTA agreement created over the past 30 years in that sort of trade policy certainty to reshore within that North American market and develop those chains. Now, this is pushing on those processes now to see where we might tighten up even more. And another one that I've definitely seen is a review, and if you will, we're going through this now, a renegotiation of our prices, our contracts, in order to incorporate the potential for tariffs adjusting our cost structures as we need out there. This has been a big challenge, I know, especially in talking with our small agribusinesses, as they have been highly sensitive to trying to pass those tariff costs along to their final consumer, the North American farmer, because they recognize that one of the challenges right now is that the ag economy is in that low point in the agricultural cycle, and therefore any tariff passage through to the farmer is just adding to those costs and exacerbating that net farm income hole that we're experiencing right now. And probably the last point here is one that is true whether we're talking about an ag economy that is struggling or an ag economy that is doing well. We're always exploring for new markets that offer growth and opportunity. It's just that now with this trade uncertainty, much more of that is concentrating on developing new domestic markets that offer that sort of growth here. And I think that's also why we're seeing much more of an interest in, for example, in how agriculture works within the energy environment, because that is mainly a domestic usage of our agricultural products that helps bolster the local agricultural economy. So I do want to bring this up though, because I mentioned that agriculture is sort of driven by this idea that we've built the industry to fit a global market. This is looking at the value of U.S. agricultural trade over the past basically 50 years. And you can see how dramatically that has changed during that 50-year time. The idea is that going back to the 1960s, 70s, 80s, agricultural trade occurred, but it wasn't the major driving engine within the agricultural sector. These days, it's worth $200 billion, not only in exports, but imports into the industry as well. And so it is a much larger component within the agricultural economy and therefore has a much greater impact on how the ag economy moves forward. Given that we have so much value here, yet at the same time, too, we're facing so much uncertainty here. That is leading to significant challenges for our agribusinesses because they've developed these not only trade partnerships, but production partnerships. As you think about how we move product, and especially in the case of our ag machinery, it's a lot like our automobile industry in that parts tend to move across country borders multiple times before that final piece of equipment is delivered to the farm. And when I look at U.S. trade specifically here, where we have seen the biggest growth over time is with those partners where we've had those free or fair trade agreements with Canada, with Mexico. And that has where we've seen the largest growth and where we are seeing, if you will, the most sensitivity within our agricultural industry right now to the policy uncertainty as we look out there. But I'll also take us back to when we think about global agriculture. There's a reason why North America has become, if you will, this juggernaut within the global agricultural markets. And it goes back to not everywhere can produce agricultural products like we can here in North America. This is a graphic that I borrowed from actually a study on biomass back 20 years ago. But it basically looks at the quality of soils throughout the globe. Basically, anywhere where you see color on the map, that is indicating you have soils where you can conduct agriculture, if you will. The colors tell you different qualities about those soils. In one case, it's talking about how resilient the soils are. Basically, how often can you farm that land year after year after year? This is also looking at soil performance, though. How large a crop can you get? What you really want to concentrate on is the bright green color. Those are highly productive, highly resilient soils. And I would argue where you see those that bright green color, those are the places that drive global agriculture. And when I look at this map, I see three big spots. There's a spot in the Northwest, and arguably, I think of most of that spot is basically called the Corn Belt because that tends to dominate global corn production throughout the world. When you look down south in South America and you see that green spot down there, that's where the bulk of the world's soybeans comes from. And then you look over towards Eastern Europe and into Russia and around the Black Sea region, and you see that spot there, and that traditionally has been where a lot of the world's wheat has come from. But it's those three areas, and it's that crop production base that drives the global agricultural market. That we're creating the crops that not only feed the population on the globe, but we're feeding the livestock. We're creating the meat that drives life here on this planet. And given that, that's why I think agriculture is more sensitive to things like what we're seeing with trade policy right now, because of this connection that only a few places can truly produce at the levels like we do here. But when we look at global demand for agricultural products, it spans the globe. I like to remind folks that when you look at, for example, a country like China, it is roughly the same size in terms of area as the US. Yet when you look at that country, one, you see in this case, there aren't really any green spots in that country. And two, the population there is what, roughly 4 times the size of ours. And that puts a lot of pressure for them to find the agricultural products they need to drive that economy. Where do they find those products? Well, they tend to find it from the green spots. And that's what helps develop our agricultural markets. So, with that, I want to sort of end up in where I started and sort of saying that when we're looking at agribusinesses and what they're going through right now, the key thing going on for them right now is the challenges we're seeing within farm incomes right now. And again, this is US data, but the idea is what we've seen is this downturn over the past couple of years. And right now, if I'm looking at market pricing, arguably we're going into our third year of that downturn. And the only reason we see this spike is because of the potential of government support to come in and help offset some of these losses. But we won't likely see agribusinesses truly building back up again until we see farm economies at least stabilize and be able to start to recover. And as they do, we know that they will look to update their equipment, and that's when we will see that rebuild within our agribusiness sector as we look out there as well. So with that, I'm going to stop, see what questions or comments we have, and I look forward to those over the next few minutes.
Great. Thank you very much, Dr. Hart, for the presentation. I believe before we go to questions, first of all, if you want to put those in the comments, we've got people monitoring that. But I believe Katie Foxwoods is here from the agriculture manufacturers, and she's going to come on with a few comments as well before we get to the questions. Katie?
Thank you, Rob. And yeah, my name is Kate Wood. I'm with the Association of Equipment Manufacturers. And just want to thank first Rep Fritz for reaching out to loop us in on this, and then for Becky for kind of liaising. We represent off-road heavy equipment manufacturing in the construction and agricultural sector, headquartered in Milwaukee, Wisconsin. I work out of our Washington, D.C. office, so I'm not nearly as cool as you all by living in the swamp. But, just briefly, I mean, so much of what Dr. Hart presented resonates with what we're hearing consistently and the discussions that we're having within our membership. You mentioned a lot of very familiar and beloved brands within our association, both in like your headline examples, as well as in referencing your discussion with our friends up in Williamsburg at Kinsey. And this really is impacting not just the agricultural equipment side of things, but the construction equipment side of things, because we like to remind folks that construction equipment is also used on farms. And so you're seeing impacts across the board from some well-known brands like C&H and Bobcat, obviously AGCO, our friends in Omaha and Kloss, for example. and so much of what Dr. Hart was presenting was resonating. We're working on some tariff scenario impacts, for example, specifically as it relates to Canada and Mexico, to kind of model out what we're forecasting, in the months ahead. We're looking at job losses at some of the highest tariff scenario rates, as up to about 120,000 job losses if things were to, for example, hit a 25% impact tariff rate, which we're still optimistic that we can work something out in the short term. But I think, equipment demand, as Dr. Hart mentioned, is really responding to kind of the challenging macroeconomic and farm-specific conditions that we're dealing with. Internally, we're looking at numbers that show that this will persist into 2025, and I would say maybe even into 2026. I mean, I think it's still too early to see that there might be an uptick. We're also looking at, one thing I'll touch on is kind of this young fleet, low replacement incentive. We're looking at a relatively young age of existing equipment fleets on both construction and in agriculture, because we've had such a, kind of a COVID boom here. And that obviously reduces the urgency for folks to replace their fleets in the near term. Operationally, manufacturers have retrenched, as kind of Dr. Hart can probably talk about, just responding to kind of the sluggish demand by scaling back their operations, delaying capital investments. Dr. Hart talked about that happening, domestically and overseas, and then reducing workforce levels. So that's going to continue to slow the pace of recovery as we head into next year. And then my life has been completely overtaken by trade policy and tariff policy this year. These are posing serious headwinds for the industry in ways that I don't think, especially maybe on Capitol Hill, staffers don't quite understand. So introducing complex and multifaceted risks that we could probably do a whole separate webinar on. But one of the things that our association and our industry is trying to put forth to lawmakers, policymakers, especially in Washington, D.C., is other ideas to help kind of support recovery efforts that don't necessarily conflict with the administration's goals to bring U.S. manufacturing back to the United States, which is something we all support. And we talked a little bit about biofuels. We're working closely with the Small Business Administration at raising caps, loan caps for small to mid-sized manufacturers to access capital. We're engaging in very serious conversations about immigration and visa process modernization. I know you hear about that as it relates to workforce demands. And then really that's the one policy that's in my face right now is trying to ensure that we continue to have this kind of competitive tax environment at the federal level. So there's a big, beautiful bill working its way through Congress right now. And in that, there are several, tax policies that could have, very beneficial impacts on the equipment manufacturing industry, not least restoring the research and development immediate expensing provision, which allows manufacturers to immediately expense R&D costs, which oftentimes are wages. 80 up to 80% can be up to wage expensing. So again, to try to kind of make sense of all of it is incredible. It can take a lot of time. But I just wanted to highlight a few things that we're working on beyond, respectfully making our case with the administration about why the trade uncertainty is kind of impacting the industry so much. So I'll turn things back over to Rob. Thanks for having me.
Great. Thanks so much, Kate. All right, I see a couple of hands raised down there in the bottom. I think Chris Beaudry, I think you had your hand up first. So if you want to unmute and go ahead and ask your question.
Yeah, more of a statement. I'm the MLA for Kelvington Wadena here in Saskatchewan, and I farm as well. I have a 6,000 acre regenerative farm in Sask, and I've been a Corteva pioneer seed retail for 11 years now. And I would say the three main issues that we're seeing up in Western Canada here, one is risk management, where our crop insurance and our private insurances just don't match the cost of agriculture today. And then this was stated already, but the access to capital is, we have one group, Scotiabank, who's kind of cornered the market a little bit, where they are offering, they're bundling up a lot of loans, making one large line of credit for farms, especially growing farms, and they're doing this fast, quick. So as a farm grows, they'll reincorporate new land, raise the line of credit, and it's allowed a lot of farms to grow extremely quickly. But if we were to have a year similar to this, a bit of drought, and land prices don't increase on the trend that they're currently increasing, we're going to see a massive pinch on some of these 10,000 acre and over farms where the access to capital is going to be extremely difficult. The opposite is for the smaller farms, where they have had that access to capital and with too many good years are in a pinch of overspending, or that our used equipment market has absolutely fallen apart when we have oversaturation of used drills, used combines in Western Canada, because the one combine can now replace two scenario with these large scale combines of today. And the third main issue that we're seeing here is access to fertilizer. The last two springs, urea has gotten tight. On my own farm, two local dealers I've dealt with have actually come 40 to 80 tons from me for a certain period of time, because it's just, logistics are becoming more difficult year over year for some reason. And we're currently in a space now where we're being told if you don't have your urea on hand by February, you may not get it in the spring.
Dr. Hart, do you want to make any comments on Mr. Beaudry's comments there?
Well, Mr. Beaudry, I mean, what he brought up was, again, some critical pieces there. The idea is the fertilizer industry, I'll tackle last first, I guess. Like I say, we've seen not only tremendous challenges when it comes to pricing, but also availability. And I know, he mentioned, the idea of needing urea locked in now. If you're wanting it, you want it, you better get it by February. We're hearing those same sorts of comments, I would say, here in Iowa, as we look especially at potash, as the critical component that I'm hearing most about when I'm dealing with Iowa farmers. But it again is a combination of higher cost, but if you will, limited availability. Those two tend to go together as we look there. He brought up risk management and the idea of that, he mentioned especially what he's seeing in Canada there is consolidation of that lending arm with Scotiabank. We haven't seen that as much here within the U.S. But the idea is, I would say what he brought up was a sort of a scenario that we do tend to see in agricultural downturns, where those farms, whether large or small, that had been more aggressive in using leverage to expand their operation during the good times are the ones that get caught in the pinch when those bad times do occur. And so I referred to it as sort of a young tigers phenomena, where it tends to be your younger, more aggressive farmers that do tend to be in that position. And so that does lead to a problem, especially in this case, when they're not only staring at more limited availability of funds, but again, the cost, the interest rate being charged to obtain that lending is much higher than it has been over the past decade.
Okay, I see Tom Shipley, you also have your hand up there. Go ahead, you can unmute and ask your question.
Thank you. Can you hear me? All right. I'm on
We can
mute.
hear
Okay.
we can hear you, and you moved the camera, so I can't see the Iowa State T-shirt anymore. I'm kind of disappointed. There we go.
There we are. There we are, Dr. Hart. Just for you.
Thank
Just
you.
for you. I'm a state senator in Iowa. Look forward to seeing my friends in Saskatchewan, Senator Ibach. You say you're going to be there, Becky, whatever. But I also chair Ag and Natural Resources budget. And the comment was made about how much part of government gets to be part of agriculture. I think it's kind of interesting to point out to people our Iowa Department of Agriculture budget is the smallest piece of the Iowa budget. And many people, they look at me funny when I tell them that, but I said, no, that's the absolute truth. Your human services, education, and all that just suck the air out of the room, and we're left to deal with it. But we do it very well. Thank you. I just listening. 2 points. Talking about possibly a big corn crop coming up. There's an awful lot of corn left on the farm. It appears to me. I was talking to local elevator, and they'd been out picking up corn on bins, but they're just simply taking the core out to maintain quality, and they aren't going back to take any more out. There's a mountain, and with the rain we've had, Dr. Hart, this last week, this thing could be huge all across the state. So that'll pose us another set of problems. But lastly, I was just interested to hear from the gentleman from Saskatchewan. And that scenario reminded me a lot of the late 70s and early 80s. You're shaking your head. I mean, lenders were giving money based on the land values going up. And then all of a sudden, when it didn't and started back down, lending operating money based on your increased land value turned out to be a recipe for disaster. And I went through those 80s, and I just hope to never have to do that again. But it looks like, I don't know, his situation in Saskatchewan, I think maybe somewhat different than ours. I certainly don't want to see us have to deal with that particular thing again. But I really enjoyed your comments on how all this is shaping up, because when I get to be involved in the budget, and that's kind of the 800-pound gorilla in the room, that the agricultural economy, how it affects Iowa, doesn't sometimes get the attention maybe that it deserves. So that's how it's going to affect the Iowa economy. We shall see.
Dr. Hart, any comments there?
Yep. Well, I'll say this. I think as we're looking at the situation, for example, in Canada, there are a lot of similarities to what the U.S. experienced in the 70s and 80s. But I also think there are some key differences there. One of the big ones I'll be watching, though, is that when we think back to the problem we had with the ag crisis of the 1980s, is not only did we have that high amount of lending, but we had a high amount of lending that had, it was no down payment, contract sales, a lot of things where we were doing it all based upon needing that growth in the value of the asset, and not having a lot of collateral or capitalization underneath it. My guess, my sense is as I look at the data that I've seen out of Canada, is that no, there's still, good solid asset structure underneath that. As Mr. Broderick mentioned, the idea is that what they're doing is they're combining these things. So they're utilizing the whole farm to create that collateralization, which we weren't doing back in the 1980s. That, if you will, you were doing each field separately in order to maximize that value. And that led to a lot of trouble as we look out there. And then I'll also hit the point of, as we're looking at, as Tom mentioned, the idea is, yeah, there's a lot of crops still available in farmers' hands from last year, along with what we're growing this year. Again, that is part of the challenge here. We have been incredibly productive over the past few years, and that has built up some stocks in farmers' hands. That is also weighing down as we look at not only ag prices 2025 into 2026, but again, leading to lower incomes. And I think that's why Kate mentioned in her comments that, as equipment manufacturers, yeah, they are seeing trouble lasting into 2026 because the farmers, one, aren't seeing improvements in income, and two, yes, they're using that equipment that they bought when incomes were good back in 2021 and 2022 to help allow them to hold that purchase off for another year or two.
And if I could I'll sneak one more question in here. I think we've got one in the chat room here from Tim Anderson. He wants to know, are there viable alternatives for the countries around the world that have typically bought our farm products to meet their needs? Or does that map on global arable land point to the U.S. still keeping most or all of its global consumers, even if significant tariffs were in place?
I will sort of argue that the map doesn't necessarily force those same customers to be purchasing from North American markets. But what it does do is, as other countries explore those alternative suppliers, that's pulling product from some other countries. And so you can think of this as sort of a game of, you know, musical chairs, if you will. That as I take one chair, that takes the chair from somebody else, who they find a chair, that takes that chair away from somebody else again. And eventually, whoever's left without the chair, yep, looks back to the market that first started this. And so that is what is arguably happening right now. You are seeing the agricultural markets rebalance, reshift to figure out how to get the trade flows that they need to conduct their business right now. For example, let me pick on China. When you look there, what they have done is they've shifted a lot more of their focus towards South America in order to find the feed grains that they need to drive their pork industry. That has been a move that they've been making over the past decade, but that has really accelerated, especially during the first trade fight with President Trump during his first term, and now during this one.
Thank you, Dr. Hart. You have been, I think this has been a super, at least for me, enlightening program. And, some of the things I think we hear in the news, it's always good to see where data and reality are actually matching up with some of those things. So I really appreciate that. For final comments, I'd like to turn it back to Senator Ibach for kind of a wrap up on the program. Again, thank you, though.
Thank you, Rob, very much. And thank you, Dr. Hart. Absolutely. Following in Rob's comments, this has been really enlightening, and it's good for you to share your expertise and your insight to make us all better producers and legislators and business people out in the field. So thank you, CSG, and for setting this up. Appreciate everyone's comments and everyone's input today. Very, very helpful. And we look forward, for those of you that will be in Saskatchewan, look forward to seeing you up there. And in the meantime, thank you all, and we will adjourn.